Good morning, my name is Carl Williamson. I'm the manager of the Nexus Global Solutions Portfolio and the Nexus Global Dynamic Portfolio. It's April 2023 and I'm speaking to you from our London offices. The Nexus Global Solutions Portfolio was down 1% in March, while the Nexus Global Dynamic Portfolio was down 0.8%. This took the respective returns for the quarter to plus 1.3% and plus 2.9%. It is worth noting that those numbers don't include a rally on the 31st of March due to a bank holiday in Malta. We estimate this would add around 0.4% to the Solutions portfolio and around 1.2% to the Nexus Global Dynamic portfolio, and clearly these numbers will fall into the April figures. Taking a look back at the quarter, equity and bond markets rallied in January as there became an expectation that the Federal Reserve would pause their interest rate hike cycle and may even cut rates towards the end of the year. However, stronger than expected data in February dashed those hopes. Then, in March, two large US banks failed, and we saw the Swiss regulator force the takeover of Credit Suisse, ending their 166-year history. That triggered fears of banking contagion and led investors to flee stocks and other risk assets and head for safer assets, such as government bonds. By the end of the month, concerns had eased somewhat, as investors had raised their expectations that the Federal Reserve may be cutting interest rates by the end of the year. This optimism was accentuated at the end of the month as the Federal Reserve indicated that they may at least pause their current hiking cycle. Although recent headlines have led to panic and turmoil in financial markets, it is important to put things in perspective. Issues around Credit Suisse and SVB seem specific to those institutions and not reflective of a wider financial banking system that is in far better shape than it was in 2008, when we had more concerns about capital ratios and opaque lending practices. Fixed income markets have gained in 2023 as yields in the US, UK and Europe have all fallen. The UK 10-year government bond yield fell to 3.49% by the end of March. This was down 34 basis points in March and down 18 basis points since the beginning of the year. This supported positions in the Solutions portfolio. The fall in bond yields both sides of the Atlantic supported growth shares, while value stocks underperformed, weighed down in particular by their exposure to the banking sector. European shares excluding the UK also performed well, while UK benchmarks underperformed, weighed down by their exposures to both banking shares and oil stocks. As noted, growth and technology shares performed well, with AMD and Infineon being some of the best performers in both March and year to date. Bank shares suffered, but it is worth noting that the portfolio's positions in companies like JP Morgan fell far less than the regional lenders in the US. This week we've had ADP and JOLTS data suggested that we are starting to see some softening in the labour market. ISM data also came in below expectations. The recent stress in the financial system may lead to further credit tightening. A moderate recession in the US was already our base case, given the aggressive tightening cycle we've seen in the last 12 months. A further tightening of credit conditions does increase the probability of a recession. The key uncertainty for investors is how the equity market will react to any recession that comes. During the month, we introduced a new position on Richemont in both portfolios. Richemont is a luxury goods company with brands such as Cartier and Van Cleef. We like the company's exposure to high-end watches that appears to be holding up far better than other sectors within the luxury goods sector. Richemont also offers one of the highest exposures to Chinese nationals. As China comes out of lockdown and continues to spend their pent-up savings, we think this could continue to be of benefit this year and beyond. At this stage, there is considerable uncertainty in both directions as to the extent to which the recent financial difficulties will impact on both activity and sentiment. The silver lining of the banking crisis, if there is one, is that it may bring about the desired slowdown in economic activity and inflation, and may mean that the Federal Reserve can pause their hiking cycle. A more sustained rebound is likely to require a continued moderation in inflation, a Fed pause and a stabilisation in earnings estimates. It's been my pleasure to speak to you. I look forward to speaking to you next month.